Avui tenim amb nosaltres, gaudint dels coneixements de John Ferguson, que és el Global Lead New Globalization a The Economist Impact. El senyor Ferguson disposa de les dades, els riscos, els reptes, tot plegat, totes les oportunitats que les empreses han de tenir en compte de cara a aquest 2026, i jo demano per ell, per John Ferguson, un fort aplaudiment. Mr. Ferguson, please. Welcome, Mr. Ferguson. Thank you very much for joining us today on this exciting journey into the future. Abans de cedir-li la paraula, només recordar-vos que vam recollir les vostres preguntes al formulari d'inscripció, que sapigueu que en triem algunes pel final de la conferència. Serà de seguida, però abans, Mr. Ferguson, the floor is yours. Thank you.
Thank you so much. Good morning, everyone. I want to start by saying thank you. Thank you for inviting me. Thank you for having me. But also thank you for allowing me to do this in English. If I had to do it in any other language, it would be terrible, be the worst presentation you ever saw. I want to spend maybe 20 minutes being a little bit pessimistic, a little bit gloomy, but in the last 3 to 4 or 5 minutes, I'll be a little bit more positive. Because as I'm going to talk about the global economy, there are a lot of things to navigate, there are a lot of things to worry about. I'll share my views on what we need to worry about, but then there are opportunities. There are other opportunities I want to share with you towards the end, and I think the best companies will navigate the hard bits and find the opportunities in the global economy. So I want to tell you a story in 3 parts. I want to talk to you about new globalization. I want to explain what that means. In part 2, I want to talk about trade and supply chains and what I'm seeing the best companies do and how they navigate this world. And in part 3, I want to talk about the top risks I see. I want to talk about the currency markets and some of the financial risks that I see, mainly stemming from the US, because there's a lot going on in that country right now. Just quickly, in terms of who we are, some of you will know the Economist newspaper. Some of you may even know the EIU, which is the intelligence unit. They do all the data and the forecasting. Economist Impact, we're the baby of the family. We've only been born 3 or 4 years ago. We work with great partners and do research on trade and geopolitics and supply chains, and then we take that research out to the world. So a quick little promotion, in the next month in December, we're going to be launching our initiative on the future of trade, trying to restore trust in global trade and hopefully help everyone navigate this difficult time. So keep an eye out for the Future of Trade initiative from Economist Impact. But let's jump into the presentation, and let's start with why I think we're in a new chapter for the world. Now, I love history, I love economic history, and I just felt like what we're living through is something extraordinary. So I wanted to test that thesis out. What I did was I went back through the EIU's Global Outlook reports. The EIU has a global report of the global economy every month, and in that global report, they look at the main drivers of the global economy, whatever those drivers are. So I went back 30 years ago and looked at what are the main words or phrases that drove the global economy 30 years ago. And that orange line, the axis on the left is the number of words or phrases. That orange line represents what we can remember as, or what was called the Washington Consensus. So this was deregulation, liberalization, privatization. These words dominated the global economy. And you see in the 1990s, these were the main drivers of global economic activity. And that stayed the same way throughout the 2000s. But then something strange started to happen in the middle of last decade, and that's when I felt like the drivers of the global economy were shifting. So my thesis is we've got this unprecedented convergence of these 3 forces: shifting geopolitics, an AI-driven industrial revolution, and climate change. And when I looked for those words throughout the last 30 years of these reports, you can see that they weren't really even in existence back in the 90s or 2000s. But in the second half of last decade, something started to happen. These drivers started to dominate what was driving the global economy. Now, in COVID, everything stopped. Everything was about COVID. It wasn't the Washington Consensus. It wasn't new globalization. Everything was about COVID. But now that's passed, you can see that these drivers of new globalization are really, really driving the global economy, much more so than those old drivers of deregulation, liberalization, privatization. So that's why you're all so busy. That's why you've got so many things to navigate, because we are, in my view, a fundamentally new chapter for the world economy. Now, what does that mean? That means a high level of uncertainty. What I have here is what we call a global uncertainty index, which, funnily enough, mentions uncertainty in the global economy. And you can see if we just look at where we are now, this level of uncertainty is unprecedented. And if I dig into these numbers, that peaked around earlier this year, around so-called Liberation Day. That was April 2nd. They didn't want to do it on April 1st for obvious reasons. But that drove uncertainty for all of you, for all of us, to extraordinary levels. Businesses can't invest. You can't invest. People can't make decisions when uncertainty is at such high levels. Now, I've used all my creative skills and put a shape there. Is that a little bit of a bright spot? I hope so. I hope so, because if we can come back to some sort of more normal levels of uncertainty, that helps people invest, that helps you with your supply chains, that helps you get on with your business. But that's the world we're living in right now. So what about global growth? Before we turn to trade, what about global growth? If we just whip across the world in a couple of minutes. If I start out in Asia, China is still a huge player, and I'll get to the Chinese trade in the next section of the talk. But economically, China's growth outlook is structurally slowing down. The EIU expects it to grow by less than 5% this year, and that's a really big change from those of you who remember Chinese growth 10 or 15 years ago. So the Chinese economy is slowing down. It has some of its own headwinds around the property sector. It's also being hurt by the US-China trade war, but China's economy is structurally slowing down. India, meanwhile, is now the world's fastest growing emerging market. So it's sort of overtaken China as the sort of fastest growing market out there in Asia. I'll come to India later. India has a bit of a love-hate relationship with global trade, but India is doing very well as an economy. If we come across the world in the Middle East, the Saudi economy, for example, is growing about 4%, which is a pretty good rate of growth. If we come up to this part of the world, and I love your part of the world, I love where you all live, this is a beautiful part of the world. The growth outlook isn't enormous, it isn't great, it's modest at best. One little bright spot or potential bright spot for the European market is Germany. If the German economy can grow, and the EIU expects it to grow faster next year and the year after that, then the German economy can help to drive more economic activity here in Europe, which is a little bit of a bright spot, hopefully. If we go across to the US, all sorts of crazy stuff is going on in the US. It's not going to hit recession, but it is going to slow down. The US economy is slowing down. The EIU expects 1.7%, slowing down to 1.4% next year. So that's not great for the world's biggest market. So I would say the growth outlook is modest at best, not dramatic, not recession, but modest at best. Let's now talk about trade, and I want to focus on Europe in particular, of course, but I want to share basically my worries, which is the fragmentation side, and some more optimism, which is the diversification side. But I honestly think that we're sitting at a moment where there are two paths ahead for global trade and all your businesses as you think about the world. The first piece of insight, the first piece of research I want to share with you is from a huge survey we did of about 3,500 supply chain executives, procurement executives, anyone involved in the private sector and running trade for their companies. And we asked many things in this survey, but this one particular question we asked, how are you responding to geopolitics with your supply chain management? The dominant strategy was friendshoring. Now, I didn't make that up, it's a funny word, but essentially what it means is shifting your supply chains to so-called friendly markets. And I think that's understandable in a world driven by geopolitics, as I mentioned earlier. It's also difficult because friends are changing all the time. Friends are changing all the time, and people have to judge, is that particular relationship between these two countries going to stay the same? And in today's world, that's a difficult thing to think about. The second one there, I'll just quickly focus on dual sourcing. It's expensive to dual source, but it makes sense. In a world filled of uncertainty and risk, it makes sense to me that these supply chain managers were dual sourcing many of their most critical inputs. So this is how geopolitics is impacting supply chains. It's a little bit worrying for me because it fragments the world, but this is the main strategy that people are thinking about. Now, I want to deviate and talk about finance because trade and finance move in the same direction. When trade flows are strong, financial flows are strong, and when trade flows are weak, financial flows are weak. So because I get to do research and get to ask questions however I'd like, we did another piece of research and we asked this time institutional investors who do all of our pension funds and all these sorts of investments for us. And I asked the same question. How are geopolitics impacting your international portfolio choices? And as you can see, the dominant strategies were to shift their portfolio investments to allied markets or even politically neutral markets. So geopolitics is now influencing even how financial managers, portfolio managers, are making financial decisions about where their money goes around the world. This is understandable to me, but it's also worrying, because this is leading to fragmentation. If we keep going down this path, we're going to a fragmented world. And what I want to share with you now is a fragmented world is a poorer world, right? I work for the Economist Group. I believe in global trade. I believe in the benefits of global trade. This path we're on is not a good path. So we did a scenario exercise where we looked at 2030. We had a few different scenarios, but I just want to focus on the middle one. We asked if these fragmentation trends that I just shared are going to continue, what would happen to the global economy? Roughly around 6% loss of GDP by 2030, which is about $6.5 trillion by 2030. That's a huge amount of income lost, a lot of jobs lost. So fragmentation is not good. No one wins in a fragmented global economy. So we should be doing whatever we can to try and reverse that trend. What is one of the main drivers of fragmentation and trade policy uncertainty? It's the US administration. Not a surprise there. Now, if anyone can tell you, forecasting is kind of the EIU's reason for being, but if anyone can tell you they can forecast Mr. Trump precisely, they're pulling your leg, right? It is a difficult thing to forecast Mr. Trump, but we have to have some idea. We have to have some assessment, some assumptions. What we've got here, because I, again, sort of love history of economics and trade, these are the sort of over 100 years history of the average tariffs going into the US economy. And you can see we're at levels now, because of the uncertainty and the sort of, flip-flopping and changing of tariffs, we are now at levels not seen for 100 years. And that's extremely difficult. But what's even more difficult is all the different shifts and changes. Our analysts at the EIU are having a hard time keeping up with all the changes around tariffs coming out of the US. But you can see that we're at enormous levels of the average tariffs going into the US. When I work with clients and businesses like yourselves, the assumption that I think we should be going with is that I think we're going to end up around the 15 to 20% average tariff going into the US. We can't forecast that precisely, but I think a 15 to 20% assumption is a reasonable assumption to think about for the foreseeable future, for the next 3, 4, 5 years. Even if the Democrats get in, they'll find it hard to undo this. So I think 15 to 20% is a reasonable assumption for the medium-term future of the US economy. I started reading about trade and geopolitics, globalization 20 years ago. I never thought I would see a chart like this, but here we are. Now, the wonderful thing about trade and economics and global economics is there are reactions, and theory would suggest this type of reaction. When the US economy, which is enormous, puts up huge barriers to trade, what happens? Those goods bounce off the US and go somewhere else. This is essentially what Mr. Trump wanted, but the rest of the world now has to pay a price. And I'm sure many of you are dealing with this price. What we have here is Chinese exports to the world. The dark blue line is to the US, and this is what Mr. Trump wanted. There are now less Chinese goods going into the US economy. But those goods are not vanishing into thin air. They're going somewhere, and I'm sure they're going into your markets. But they're also going to ASEAN, LATAM, and Europe overall. Now, if you're a consumer, that might be a good thing. You get more goods, you get more diversity of goods. But if you're running a business, this is very difficult. And one of the things we should expect, and you're probably feeling it already, I think there's going to be a bit of a political pushback against these Chinese goods flooding the European market and some of these other markets around the world. But that's what's happening. As the US puts up barriers, those Chinese goods are finding other markets around the world, putting pressure on many, many businesses like yourselves. So what we did, and this is a whole big study, you can connect with me and I'll share it offline, but I just want to share, we tried to look at what are the main European goods, products at the product level that are most vulnerable to these Chinese inputs. And we thought about things like price and specialization, which is the competition pillar. We thought about how dependent certain sectors are on Chinese imports. And we thought about the commonalities between the US market and the European market to try and get a sense of what we call the Archimedean trade index. Maybe not the best marketing term for an index, right? But basically as things come in, other things will flow out like Archimedes, right? But essentially we found some of these goods we think are particularly vulnerable to Chinese imports like textiles, certain products of wood, games, toys, and sporting goods. Now, that's not a prediction. We just think these products are particularly vulnerable to a sort of an influx of Chinese goods. But that's definitely something to keep an eye out for. And again, we expect some tensions to arise, not just here in Spain, but in other parts of Europe, because of the influx of these Chinese goods. Now for a bit of optimism. I mentioned before that fragmentation is my biggest worry for global trade, but what excites me or makes me more optimistic is how the rest of the world, in particular the EU, is reacting. This is a chart that my team produced a little bit of time ago, but it's still relatively up to date. It just shows that the EU is trying to do a lot of trade deals. You know, Mercosur is one of the ones I'm most excited about. I think Mercosur offers a great opportunity for the EU and EU companies. But also there's potential talks with the Aussies. The Aussies are great people. You should do more business with the Aussies, right? India, huge market. I said it's got some challenges with trade, but if the EU can get a deal with India, that would also be positive. But this is how the rest of the world should be reacting. If I think the US is going to remain in this protectionist mode for 3, 4, 5, 6, 7 years, this is what businesses need. These are the opportunities that are being put in front of you, and I hope that many of these agreements do get finalised and agreed, because what businesses need is certainty. New markets, new opportunities, but also certainty of trade rules and trade policy. So this is promising in my view, and I would encourage more of that behaviour as someone who believes in global trade. So to summarise, therefore, I think there are two paths ahead. On one side, there's a fragmentation. On the other side, there's the opportunities. And when I put this, I'm not very creative, but when I put this amazing chart of 2 square boxes on this slide, there is more text on the right, on the opportunity side than the risk side. On the risk side, what the worry is just growing protectionism. If we think that the EU will have tensions with China over the next 6 to 12 months, that is a worry. What if more markets do that? That's the worry, that we get a creeping protectionism across the world. But there's more opportunities, there's more text, there's more things I could write in the opportunities box than the risk box. Countries are joining up to join CPTPP, the Comprehensive and Progressive Trans-Pacific Partnership. Thank God I had some coffee this morning. That's a good thing. Why are countries trying to join the CPTPP? Because companies want rules, they want certainty. That's a good thing. The WTO has many challenges, but it's doing some good things. They're moving ahead on e-commerce, for example. Digital agreements, digital discussions, these are positive. Mercosur, I've already mentioned, really positive. And if anyone does business with the Middle East, you'll know that the GCC and the UAE in particular are really pushing ahead with trade deals. This is positive. And India. India has a bit of a love-hate relationship with trade, but what fascinates me is when Trump put up 50% tariffs on India, I know, because I have contacts there in the market, they turn to countries like Australia because the factories are there willing to have partnerships, willing to do business. So they turn to the Aussies. The Aussies are more stable than the Americans, right? So this is how the rest of the world is reacting. You have all these risks. You have the US doing what they're doing. The rest of the world is trying to adjust and trying to create more certainty for businesses, and that's where I think the opportunities lie. Now, if you can allow me 3 or 4 more minutes of doom before a bit more positivity at the end, I want to share with you some risks, some currency outlooks, because I think anyone who's running a global business, doing trade, managing supply chains, I think you do need to pay a lot of attention to currency, interest rates, and financial risks. So, as many of you will know, you deal with the US dollar. The currency markets have really changed this year. And here's a forecast from my colleagues at the EIU about the euro and other currencies, but just focusing on the euro. We're not going to go back to where the US dollar was in the last 3 or 4 years. The EIU expects maybe a slight appreciation of the US dollar compared to the euro, but we're not getting back to where the dollar was previously. That's reasonable, and that's a reasonable assumption. But what I would suggest is that I expect, unfortunately, a lot of volatility in currency markets. Now, some of you have probably read, or you're going to see, a lot of research about de-dollarization, right? Markets like the BRICS and others who don't really want to do business in the US dollar. They want to create their own groupings and whatever. That's fair. Now, you'll see research that says no other currency can become the reserve currency of the global economy. The euro's not quite ready, and I think that's a fair point, right? Despite what maybe the Europeans want. The worry for me is that if Mr. Trump keeps attacking the Federal Reserve, Jerome Powell, keeps undermining confidence in the US dollar and US assets, The worry is not that there's not a second or a currency to replace the US dollar. The worry is a global economy where there's no safe assets. Okay? In the global economy where there's no safe assets that investors can rush to in times of risk and uncertainty, then what you end up with is just more volatility. I can't forecast volatility. If I could, I'd be a rich person. But I expect more currency volatility over the next couple of years because of these trends, because of these concerns around the US. Now, this is not to be too dramatic, but I do think we're laying the grounds for the next financial crisis. Okay, that's not a prediction. I just think this is what people need to be thinking about and just preparing for and strategizing for, okay? All of these risks on their own are worrisome. When you combine them together, they become more problematic. And I'll just quickly go around. The big, beautiful bill was big but not beautiful there in the US. As many of you will know, it added a huge amount to the deficit and therefore US debt, and it's a major worry. My colleagues at the newspaper, the Economist newspaper, wrote a big piece on this recently and basically said one of the probable outcomes is just to inflate that debt away. Now, inflation is not good for anyone. I don't know, it may be good for someone, but not good for most. And if inflation goes up, interest rates have to respond. And what does Mr. Trump hate the most? High interest rates. So that US debt deficit is a real concern. The US stock market, again, if I could predict the stock market, I might be on a Spanish beach somewhere. It's elevated, but whether it corrects by 2% or 20%, I don't know. But the problem is, if there is a crash, it's really hard because of that debt situation for the US government to support the economy the way they've done in previous crises. Okay? If we come down to stablecoins, it's exciting, it's a growing part of the US financial system. And they're trying to build safety with stablecoins by making stablecoins be linked to US treasuries. My concern is if what happens with a stablecoin provider who then has to dump their treasuries, price goes down, interest rates go up. What does Mr. Trump hate? He hates high interest rates. And then generally they're back down there with the loss of trust. If Mr. Trump continues to threaten Jerome Powell, threaten the independence, undo those norms that creates trust in the US system and the US dollar, that again adds to interest rate pressures and financial pressures there in the US. Now, this is not to say we're going to have another financial crisis. This is just to say these are the risk points that I'll be looking at and thinking about my currency exposure, my interest rate exposure, and just how I'm trying to navigate some potential volatility in the next couple of years. So my final slide, I just want to wrap up and say, I spend a lot of time, fortunately, working with people like yourselves, going to beautiful parts of the world like Barcelona. And I spend a lot of time with boards and business leaders. And this is what I wanted to share, what I see the best business leaders doing in this new chapter of globalization. The first one there is everyone's clearly developing an active approach to risk management. And maybe 10 years ago, we might have done a business continuity plan in January. We might have put it away in the drawer in January and not thought about it. But things are moving so quickly. If you again look at that Indian example with the US, that happened really quickly. And now Indian businesses are turning towards countries like Australia. These things happen really quickly. I think in this world, rules of origin are going to become even more important. People are trying to understand those tariff differentials and sort of, take advantage of tariff differentials. You need to be clear on what Mr. Trump might do, which is difficult. But I think rules of origin are going to become even more important in the next few years. Clearly, everyone's trying to build diversified and sort of resilient supply chains, but people have been doing that since COVID and the war in Ukraine, but that has to continue for obvious reasons. But what I'm also seeing down the bottom there is I'm seeing a lot of work between the CFOs, the CPOs, the supply chain managers, the GCs, because all of these business leaders have a role to play in risk management, supply chain management, and strategy management, because they're all exposed in different ways. I think the CFOs should be all over those financial risks I spoke about earlier, but they clearly matter for supply chain managers as well. Up on the right there, I am optimistic about AI in the medium term. I think we've got a dip and we can talk about that in the break, but I'm optimistic about AI in the medium term. But in my view, the companies that are going to win the AI race are the companies that get that culture right and get the human-machine nexus right. And I'm seeing many people experiment. Some of those experiments might not pay off, of course, but many of them will. And I just think those companies that get that augmentation right of what AI can do for us with their companies, I think those companies will be the ones that end up winning. And the final one there, just to try and finish on a positive, is that I am excited, or I am encouraged by how the rest of the world is reacting to this period of trade uncertainty. The EU is leading the way. It takes time to do trade agreements. I heard last night maybe the French don't want the Mercosur deal. So on, like, these things are hard. But that is the direction of travel. And if I was running a business and looking for new markets, either for my imports or my exports, I'd be following those trade agreements and trade partnerships. Companies and countries like the Aussies, those out in Asia, those in the Middle East, and clearly here in the EU, want a world where we have a rules-based order. You know, companies need rules, they need certainty, they need stability. And many companies and countries are looking to do that, and that's where I think the opportunities will lie in the future. But that is the end for me. I just want to thank you all for listening, and happy to take any questions, but thanks so much everyone for listening.
Thank you very much for this conference. I have to say that your words have been an opening look into the new globalization era. I'm sure that we are all now more prepared to navigate this uncertain world. We have received some questions from the audience. I know we all have many questions, but we have time for just a few. We have selected a few, so I'll go with the first one. If US tariffs remain in place, which policies should Europe prioritize?
It's a great question. I think Europe should be prioritising those trade deals. What everyone needs is certainty, as I mentioned. But more broadly than that, I think we need the EU standing up for trade, values. Values of international trade, which doesn't mean throwing your allies under the bus, which doesn't mean threatening tariffs every 10 minutes. So it's the policy side is the trade agreement side, but it's also standing up for a rules-based order, a rules-based system. It wasn't perfect, we can revamp it, but what's the opposite of a rules-based order? Chaos and fragmentation, right? So I just think, trade agreements, values of trade and openness, that's what I think the EU should be doing.
Second one, the last one. The protectionist shift, a structural trend or a reversible one?
Exactly. Well, for the US, it's structural. I really, as I mentioned before, I think we saw after Trump 1.0 that the Biden administration actually went a little bit further. Mr. Biden did not undo the tariffs of Trump 1.0. So for the US, I think this is structural for the medium term. Even if a Democrat wins, and just to share my view, because I like sharing my views, I think we've got one more year of peak Trump. I could be wrong. I hope to see you in a couple of years. You might say, John, you were wrong about everything. But I think we've got one more year of peak Trump to the midterms of next year, and then slowly but surely his power is going to wane because J.D. Vance and others will want to be the next president. The Democrats had a good week last week. They will want to come back into power. But even if it's J.D. Vance or the Democrats, I don't think they'll be massively undoing that tariff picture that I shared a few minutes ago. So for the US, I think it's structural. For the rest of the world, I think there's those two paths ahead. I really hope we take the openness and trade rules and rules-based order approach. So for the rest of the world, I think it's still up for discussion.
We truly appreciate your presence here today. It's been an honor, honestly. John Ferguson.
Thank you.
Thank you.